Royal Bank of Scotland's management turned a blind eye to widespread failings at its notoriously ruthless division. It was meant to help struggling small firms, according to secret documents. The Mail on Sunday has seen an unpublished official report into the behavior of staff at the bank's global restructuring group. The report, covering from 2009 to 2013, reveals management pressured staff to squeeze companies in order to make more profit for the bank. GRG became a byword for corporate cruelty after the financial crisis. Scores of small firms complained that the division exploited them at their most vulnerable, when it should have been helping to restore their fortunes. Staff at GRG were told, "Sometimes you need to let customers hang themselves." Another instruction for employees read, "Missed opportunities mean missed bonuses." An investigation was ordered by city watchdog the Financial Conduct Authority. The report, which the regulator has refused to release in full, repeatedly points to the fact that management did not stamp out widespread unscrupulous conduct which went on for years. The damning judgment that management either knew or should have known about the predatory treatment of firms is peppered throughout the report. It cited each of 9 separate serious failings detailed in a shorter summary report. Criticisms included the fact that substantial charges were squeezed out of troubled firms and there was a failure to deal properly with complaints. In addition, bank staff neglected to make sure entrepreneurs' interests were properly protected when GRG swapped loans it had made for a stake in their business. The findings are significant because they could be used by firms to take action against RBS or the individuals concerned. Several groups are bringing GRG-related lawsuits against the bank, including one coordinated by claims firm RGL Management and another from Developer Property Alliance Group, whose £30 million case reaches the Court of Appeal in January. One memo included in the report was entitled "Just Hit Budget" and instructed staff on how to make the fees they imposed on firms look plausible. It urged staff to avoid round numbers because £5,300 sounds as if you have thought about it, £5k sounds like you haven't. These instructions were issued in 2009, when a regional office was behind target and needed to deliver. The bank said the language was completely inappropriate, but claimed these were isolated incidents. But the report said the memo gives a wider sense of the culture of GRG at that point, and that weekly emails congratulating staff on deals to extract income from firms were being used in at least one other office. The FCA said this is because former managers have not had a chance to challenge them. No individuals are named. GRG was run by executive Derek Sacht, later an advisor to private equity group CVC. Stephen Hester ran the bank from 2008 to 2013. He is now chief executive of insurance giant RSA. The head of corporate banking for much of the time was Chris Sullivan, now at Santander. All four declined to comment. RBS itself would not comment, but as previously denied, having a deliberate strategy of exploitation.